Most people think real estate is about buying properties. It's not. It's about building a system that lets you keep buying properties without running out of money. Let me show you what I mean. To buy a $200,000 rental property the normal way, you'd need to put about $40,000 down. You rent it out, it cash flows, and then you wait. You save for years and then you do it again. That's why people get stuck at one or two properties, but investors with 50 doors, they're playing a completely different game. They're not leaving $40,000 sitting in that house. They're pulling it back out and using it again. That's the BRRRR strategy. Buy, renovate, rent, refinance, and repeat. And when you do it right, you can turn one chunk of cash into an entire portfolio. In this video, I'm breaking down each step along with the biggest mistakes that people make, because if the math doesn't work, your money gets trapped. And I'm going to show you how to make sure that doesn't happen. If you're new here, I'm Amy Rendy, and I'm passionate about empowering others to invest in real estate. Now, traditionally, to purchase a property, you need about 20 to 25% down for most loans, unless you buy creatively. So let's say you bought a house for $200K and you were going to put 20% down. That would be $40,000. So you put that money down and you can rent out the property and hopefully it'll cash flow. You're probably thinking, though, how do investors do this? How do they own 50 properties? Do they just have millions laying around? How else would this work? Here's what real estate investors understand that most people don't. The property is the asset and the cash is the tool. You're not supposed to leave your cash buried in the properties. You pull it back out again and you use it. That same $40,000 you can use to buy properties over and over again if you know how to recycle it. That's where the BRRRR method comes in. Once again, BRRRR stands for buy, renovate, rent, refinance, and repeat. When you buy, you need to make sure that you buy a property that needs work. That's the only way the BRRRR method really works. You buy it at a discount, and you know that by putting some money into it, you can increase its value. So let's say you buy it for $120,000 and you estimate that it's going to be worth about $250,000 after you renovate it. So you're looking for that gap. You want to buy a house that's ugly, fixable, and pretty much underpriced. Why? Because that gap or that difference in value is your equity, and that's where the money comes from. The rehab. What you're looking to do is to add value. You need to add value so you can increase the appraised value when you're done renovating. You want to focus on items that are going to increase value, like bathrooms, kitchens, flooring. In a BRRRR strategy, it's all about the appraisal. Your appraisal is going to be based on comps, so you have to know what your comps are before you buy the property. Comps are properties that have sold, preferably within a quarter of a mile of your subject property, maybe out to a half a mile, but it has to be in the same neighborhood and not across major or busy streets. It should really be within the last 90 days that the property sold, but no more than 6 months. And you have to compare apples to apples. If your property is a ranch, you need to look at a ranch. If your property is a colonial, you need to look at a colonial. These items are crucial because that's really what is going to determine your after repair value or your appraised value for the appraiser. You want to look at square footage that's very close, plus or minus 10%. You want to have the same bed and bath count, same garage, basement, no basement. Those are all things that are going to really be important for you to look at. And then you're going to rent the property. Some lenders will require that the property be rented before you can start the refinance process, and others don't care. So you just need to know what your lender requires before you start the process. And then you go for the refinance. So this is where most investors go wrong. Your refinance is based on that after repair value or the appraised value after the property's been renovated. This number is going to drive everything in the BRRRR method. So you need to be very confident before you even buy the property what that number is. So what you're going to do is you need to find a lender that is going to let you do a cash out refinance. For rental properties, you'll most likely use a DSCR loan or a rental loan. They will lend a certain loan to value or LTV, and that value is based on that appraised value. So sometimes it'll be 75% or 80% of LTV. And like I said, in this case, that value is going to be given to you by the appraiser, and they'll lend a portion of whatever they appraise it for. So in an ideal world, what you'll be able to do is after that appraisal, you'll be able to pull all your cash back out. And that way you'll be in the deal for essentially no money. When this happens, you're essentially making infinite returns because you have no money of your own in the deal, and you just continue to multiply that money deal after deal. And then you repeat. You take that money out, you do it again, same strategy, different property, and that's how you scale. You're not waiting to save up. You're recycling the same capital over and over and over into new deals. Now, here is where people a lot of times mess up. You're excited, you find a property, but you didn't really run the numbers. You maybe bought a little bit too high, you underestimated what the rehab or the repairs were going to be, and maybe you just spent too much. And so when you go to refinance, the bank says, okay, we'll give you $150K, but you have $180K into the deal. So is it the end of the world? No, absolutely not. But your money is stuck. So before you buy, you really need to know three major things. What you're paying. Is what you're paying a good deal or a discount for this property? It really needs to be in order for the BRRRR method to work. Then you need to know your rehab budget. What's it going to cost to fix up this property? And then you need to know your ARV, or how much this property is going to be worth when you're done. If those numbers don't work, or you don't leave enough room, when you go to finance and pull your cash out, you're most likely going to have to leave some in the deal. So you just want to make sure that you're accurately accounting for all of your numbers. The BRRRR strategy has been around for a long time, and it's still very popular because it works. It allows you to scale without using a ton of money or keeping a lot of money in the deal if done properly. Old school investors will tell you just to save up for each property. They'll say, just keep working at your W-2, keep saving, and maybe in 3 or 4 years, you can buy another property. And you know what? That's what most people do, and that's why they're never able to scale. They keep leaving their cash trapped in those properties instead of using it over and over again to scale. Your money is your tool, and your property is your asset. Get the tool back, build the next one, and that's how you repeat. When you master the BRRRR strategy, you're not just buying properties, you're building a system, and you're thinking like a portfolio investor. And that's when you stop trading time for money and start building real wealth.